Hello and welcome to this week's episode of Coinscrum Markets. I'm Pierre Martinow. Coming up, Efficient Frontiers, Roei Levav takes a look at the markets in crypto RFQ. Paul speaks to CommerceBlock CEO Nick Gregory about the latest Bitcoin scaling solution they're working on. And Steve Berryman and Robert Olson from Attestant join us to give a lowdown on this week's launch of the ETH2.0 beacon chain. Make sure you remember to subscribe to our channel. Next up, Crypto RFQ.
Welcome. I'm thrilled to be joined today by Roei Levav, co-founder and CEO of quant trading firm eFrontier. Welcome, Roei.
Thank you very much, Paul. Great to be here. Thank you for the invitation.
Absolutely. Can you just tell us a little bit about eFrontier before we dive in?
Yeah, so we go by Efficient Frontier. eFrontier is the kind of the domain name. And Efficient Frontier is basically an algo trading company. We started developing strategies and HFT infrastructure since 2006 in traditional markets. In 2017, we kind of felt the crypto ecosystem is mature enough for us to jump in. The idea was taking our technology and infrastructure and knowledge and practices and apply it to this nascent market. That's proven to be very successful. We were involved in the industry since 2013 individually, but kind of felt that this is the right time. That's been, it's been pretty successful. We since broadened our suite of solutions and services to other verticals, and now working with some of the largest companies in the space. We see ourselves as part of this group of companies that bear the responsibility to improve the market, to advance the industry and the ecosystem, and we are happy to be part of that movement. We are seeing ourselves as crypto first and trading shop.
So look, this week, big week, Bitcoin made its all-time high again, just by a smidge. Just scraped it. It's kind of toying with it, keeps coming back. We'll see what happens there. There was a lot of attention on Ethereum with the triggering of the ETH2 beacon chain. So starting that process of upgrading Ethereum to migrate from proof of work to proof of stake. And compared to earlier in the summer, I guess some of the attention around DeFi has kind of has drifted off a little bit. But as we know, it's crypto. There's always things going on beneath the surface. What are you seeing? From a trading perspective, I assume you cover kind of the market quite broadly. In terms of new assets and new products coming to the market, what are you seeing right now?
Yeah, so it's interesting to view. I mean, we are connected to the backbone of the infrastructure of the trading part of the industry, and it's been pretty nice to see the progress, exchanges, infrastructures, products made specifically last 6 months, but I would say it's the whole year. So from a latency perspective, robustness of the infrastructures, APIs, products, all of this kind of stuff were very made a pretty, I'd say, an aggressive progress over the last 6 months, and we've been obviously part of that. So I think exchanges, while they are facing a very significant challenge, not being just the matching engine, by being the broker itself, the bank, holding them funds, giving the leverage, taking the risk, all of that, and having millions of people are connecting to the website at the same time. This is actually a larger challenge than traditional exchanges facing in that sense. So it's good to see, and we coming from traditional markets, so we know to appreciate that progress. We are seeing that approaching traditional market level, I'd say, in some cases. We are still seeing things that you won't probably see in traditional markets. What happens with some large exchanges, halting withdrawals and stuff like that. So that's kind of still alarming, but that's fine. It's a new market. It's growing. It's in infancy, I would say. But at the same time, we are seeing round trips makes being much better, security wise, being much better. We see companies like Copper or Fireblocks connecting to more and more exchanges and more parties. We are using some of these solutions as well. So we feel comfortable about that, even if things happening and from a tech perspective, from a regulatory perspective, we feel comfortable where we are now, and it's progressing. So I think on the products side, you mentioned DeFi, you mentioned other stuff. It's interesting to see. I think one of the most interesting things that we've been recently viewing is the STOs market. So INX getting SEC approval to sell security tokens to the masses. This is amazing, right? This is like a real breakthrough, and we are on top of that. And them buying open finance for the regulatory perspective and assets. That's a real advancement. I think DeFi is definitely interesting. That's been a huge hype for a few months, and then as you mentioned, kind of went down a little bit, and now it's where it is. We will keep seeing this. Crypto is experimental in many ways, and while you asking the STOs guys, they will say, this is going to be 95% of the market, and DeFi and all that will be part of that. It really depends on how you view that. I think we are kind of in the middle of that. I think DeFi and decentralized systems and all that have an amazing value to provide, but at the same time that there's a long way to go. So yeah, that's been very interesting ride.
Sure. So just elsewhere in the market in terms of kind of other new products as well. We over the last couple of months we've seen kind of dominance of CME futures, so on the regulated side, sort of increase. And I think last week they actually surpassed OKX in terms of open interest. What are these kind of more retail focused unregulated exchanges now doing in terms of to kind of bring new products into the market, and what value are you seeing from these?
Yeah, I think, derivatives is always, was interesting for us. If you want to see the market go mainstream, at some point, there's different reasons for that, but I think, one very strong use case is the hedging opportunity. So you cannot really expect a pension fund with like $10 billion under management to put $2 billion on Bitcoin and wake up tomorrow seeing it's 10% down. This is not how things work, even from a regulatory perspective. They need to be able to effectively hedge their position to a large extent. And for that to happen, you need to have a deep, healthy derivatives market, whether it's, futures or what we have perpetual here now, but also options, right? Which is super small right now. So I think while players like PayPal now open the gates to more retail, and we are seeing some new flows into the market on many exchanges, actually, not just the large ones. We think derivatives, and by the way, creating accessibility to products that are a little bit more complicated, like options. All right, so now you have this whole space of gamification of products, where you actually you can buy and sell pretty much whatever bet you want. If Bitcoin hits $30,000 next 3 months or whatever, stuff like that. You might not know anything about options, but this whole offer is behind the scenes structured by an option, right? That's somebody write for you, and you buy it, and they sell it, and you both share the risk. So we are seeing more and more interesting stuff like that coming up. And as a market maker, as a liquidity provider, and an algo trading, we are trading around $150 million on a daily basis across most of the products. Option is still small; it's still experimental from our perspective, but it is getting there. And we definitely are design partners with several of these players that are working on the risk management side of things, on the offerings, on the products, and how things should work. Yeah, this is very interesting, and I think next year is going to be a significant year for that. Will be a significant ramp up.
Sure. And I see Binance have recently launched a couple of new perpetual swaps, XRP, I think, and Link as well. What's the depth like in these contracts? I mean, is there enough for you to, is enough for everyone to kind of take advantage of, or?
Yeah, it's still limited. I mean, the previous, I'd say the old view on this stuff, maybe to some extent it still is, and it's right, is that, if you are an asset issuer, you might not want to be on derivatives or have derivatives for your asset, because now you can, people can short it. Mm-hmm. So there's a mix, but at the same time, it's actually opened the gates for much larger players and much larger volumes and trading opportunities. So this is always a game like that. We've been discussing with a lot of these players before, and kind of the debating or thinking about whether they should do it or not. I think it's really a matter of size and maturity of the industry. So you do need to have a derivative, an effective derivatives market for an asset generally, because then you have like a solid price discovery process, right? You cannot just have something that goes one way, right, and everybody's happy, and if it goes the other way, everybody's sad. That's not exactly how it works in sophisticated markets. Mm-hmm. So in general, I would say you have to have that. Right now, it's still small. It's still early days. We are seeing that growing. Bitcoin is still very dominant. I would say probably 85 to 90% of the market on derivatives. Ether is probably somewhere around 5 to 10. It is growing for sure, but it's still small. I'd say we need to see more, more retail, more players, more funding, more flows into the market for that to grow.
Sure, but the exchanges do have a responsibility not to launch some of these things too soon. The temptation would be just to launch a perp swap for everything and then just generate more revenue through people flipping them around, but it's not necessarily healthy for the market as a whole.
Exactly. Right. Exchanges are playing an enormous role in this, for sure. So they could have done this, and some did actually, but it was not very successful. So I think now it's a lower pace, more healthy kind of trend.
Roei, we could carry on, but we'll leave some stuff to discuss next time you come and join us. We hope to see you again very soon. Cheers.
All right, cool. Thank you, Paul. Bye.
Although Ethereum's been stealing the scaling headlines, with the first phase of its move to proof of stake activating this week, Bitcoin has been taking some baby steps of its own towards much needed efficiency improvements with the recent activation of the Taproot upgrade process. Nick Gregory, CEO at CommerceBlock, joined Paul to discuss what it might mean for the future efficiency gains.
Hello, and I'm thrilled to be joined today by Nick Gregory, CEO at CommerceBlock, a Bitcoin and blockchain infrastructure development firm based here in London. Welcome, Nick. Thanks for joining us.
Hello, Paul. Thanks for having me.
Absolutely. Can you just start off by telling us a little bit about CommerceBlock and what it is you do?
Yeah, so we've been around since 2016. We're very much a blockchain infrastructure company, very much focused on Bitcoin, and we've been building various solutions to integrate Bitcoin into enterprises and various retail apps as well, and scaling solutions.
Great. So yeah, scaling, I guess that's a hot topic. Prices up, adoption's growing, more people coming into the market, more activity on the networks, and congestion's building generally as activity builds. We saw the first phase of the ETH2 launch this week, or the upgrade. Triggered this week when it hit its threshold for deposits into the deposit contracts, which will start the process, a 2 or 3 year process for fully migrating the Ethereum network over to proof of stake from proof of work. And I guess Ethereum was inspired in many ways by Bitcoin scaling limitations, lack of throughput, and lack of composability, as it's termed now. So, we've had, and I think you were working on some of the early proposed solutions for scaling Bitcoin. I guess one of the earliest was Statechains. That's something you've been working on, or have been working on, along with companies like Blockstream. other scaling solutions on layer 2 like Lightning, and still hold much promise, but there's still much work to be done there as well. And more recently, Bitcoin, the proposal for another Bitcoin upgrade, which would introduce Taproot and Schnorr signatures, if that proposal is adopted, should also see some kind of efficiency gains on the network as well. So I guess as a use case for these scaling solutions, things like clearing and settlement, for speeding up clearing and settlement and finality, has been closely looked at. So should we just start by looking at, where we're at with some of the Bitcoin scaling solutions? So maybe if we start with sidechains, if you can just briefly explain a very high level, what sidechains are, how they are proposed to work, and what work you were doing on them.
Sure. So, if you think of a blockchain, it's basically a database of cryptographic proofs. Unlike every database, it's finite resource. And a sidechain is essentially a data structure, a similar blockchain, on top of that existing blockchain, where, it doesn't have the same kind of security constraints. It doesn't have the same throughput constraints. It's a bit lesser. So the kind of sidechains out there, you have Blockstream, which is kind of like a federation of members where people can move their coins into a less secure space, but then get higher throughput. So basically, we've seen with Bitcoin that, block size is limited, and it's premium real estate, premium real estate, and there's competition for that real estate. So by going onto a sidechain, you're essentially going onto another blockchain, but you're pegging from the original Bitcoin blockchain into a blockchain which is arguably relaxes a lot of those kind of requirements. So for example, on Blockstream sidechain, it's not mined, there's no miners mining it. It's basically 15 federation members of a federation that are approving the blocks. The work CommerceBlock did was basically have a private sidechain for the institution where Bitcoin could come in from the main blockchain and be pegged into this private sidechain. We actually never worked with Bitcoin in that sense. We just used Bitcoin's proof of work to secure it. And then we worked with companies that wanted to do things like secure gold or trade gold on that sidechain. But that's the way to look at it. But interestingly, what we saw in the last year is that, in a weird way, Ethereum became a sidechain to Bitcoin. A lot of, you probably heard of wrapped Bitcoin, but in the DeFi movement, the DeFi use case, a lot of that was basically Bitcoin wrapped in a kind of Ethereum construct to be traded inside of Ethereum. So you could argue and say that Ethereum has become a sidechain for Bitcoin because of DeFi, etc.
Is that because ultimately with wrapped Bitcoin or Bitcoin which are being used on the Ethereum network are basically under the control of a third party or a federation of third parties?
Yeah. So you have a multi-sig, people peg in their Bitcoin into a multi-sig, which then issues a wrapped version of Bitcoin. And I think that happened because a lot of the DeFi use cases, they wanted an asset that they could trust or they liked. And of course, I think the most popular asset was probably still USD Tether. But then I think at one point, up to $2 billion was actually locked up in wrapped Bitcoin. So, it really did become a scaling solution in a way for Ethereum, for Bitcoin.
Sure, but these things aren't, to be clear, fully decentralized. There's always some level of trade-off between efficiency and security.
Correct. So none of these sidechains are arguably truly decentralized. You're always trusting either one person or a group of people. So whether that's a federation, and you have to trust that the members of that federation are honest, or I think with wrapped Bitcoin, it's essentially just one custodian that you have to trust. So it's not decentralized. Correct.
Okay, so what about the Lightning Network? How does that differ? What is that solving versus something like a sidechain? And what are the trade-offs there?
So Lightning's, again, going back to a database analogy, is more like a cache. It's a cache of transactions that sit on top of the blockchain. And I think the way that they call it is payment channels. So I basically can take some Bitcoin, lock it in a payment channel, and then send off-chain transactions to, say, yourself. Now there's a lot of complexity there. Like the transaction has to be routed to you. So there has to be a network of nodes which are willing to route. And that requires quite a lot of liquidity to be locked up, because to operate a node, someone has to run a node, lock up liquidity to allow that transaction to go through. And at any point in time, I can then close my payment channel and that will basically settle on the Bitcoin network. And there's some limitations, like there needs to be a network operating which has, you know, enough liquidity allowed. Also, my node has to always, my kind of Lightning payment wallet always has to be running. So I have to always be online. So there's constraints. But you know, it's been a slow journey with Lightning. I think, you know, one of the issues with Lightning is probably a human thing, in that many people don't want to spend Bitcoin at the moment. You know, it's kind of gone into this kind of store of value mode. But there are small use cases around micropayments where you're starting to see it, you know, prop up. And you know, it's a complicated project, but it's slowly gaining that liquidity. But it's been a slow journey. Also, the UI experience is a bit different because you always have to have your wallet online. So some people have been using custodian wallets as opposed to non-custodian wallets.
Sure. And I guess that's always been a thing. You know, the argument for scaling has been to achieve more throughput, to enable kind of regular micro payments for general items, everyday items, for paying for your coffee and things like that. But I guess, as I said at the start, you know, really the majority of economic activity on these networks is trading related. So the other question that's arisen is like, well, you know, around the ability to clear quicker and settle quicker between trading venues. You have a lot of traders that are arbitraging. Ideally, if they could instantly move funds between exchanges, that would open up lots more opportunities and in theory create more efficient markets. Now, people have looked at, you know, we mentioned side chains, we mentioned Lightning. I mean, I think, you know, Blockstream's first use case for their network was to create a clearing network between exchanges. I'm not sure how kind of broadly or widely adopted that's been. And I think people were looking at something like Lightning that could also achieve those same objectives. And rather than looking at the micropayment side, look at instant settlement between exchanges and traders and brokers, etc., actors within that ecosystem. Do you think that's achievable? You know, is that is it something that could end up being adopted using side chains? Is Lightning the right technology for that?
Well, they all have trade-offs. I mean, one of the biggest trade-offs is Lightning. You know, exchanges are very much the gatekeepers of the way people trade, and exchanges don't want people to necessarily easily move their funds off the exchanges. We've probably seen that. I think the challenge with Lightning will always be liquidity. I think you're going to have a lot of liquidity locked up in payment channels to move that amount. Sidechains is going to be adoption, and also with sidechains, it'll never be instant. You're even with a kind of like a federated sidechain, you're still going to be looking at 1 or 2 minute block times. And again, it comes down to adoption. You're going to have to get you know, multiple exchanges agreeing to a certain adoption. I think what we've really seen is batch settlement, but I think things will change when the Bitcoin price goes up. I mean, in terms of like transaction fees, we haven't seen the Bitcoin transaction fees of 2017 yet, which I think were around, you know, $30. I think I remember in 2017, I may have done a few transactions that were over $50. At the moment, you can still do most of your work for $5. But with a bull run coming, you know, I think people are going to start to look at that, because it's going to be very hard for traders to kind of like arbitrage across different exchanges and move instantly. And, you know, obviously, at the moment, you know, exchanges are basically relying on batch settlement. I think other things are going to have to come in. Obviously, I'm going to promote Statechains because that's something that my company is working on. But I think Statechains and sidechains are probably more likely to be the approach than, say, Lightning, because of the liquid locked up. I see Lightning as more a payment solution, maybe for micropayments, etc.
Sure. I guess, as always, these things aren't a problem till they become a problem, and we saw it briefly in 2017, but you know, it dissipated quite quickly once the markets kind of slowed down and calmed down a little bit. But it will become a problem again, and fees will become an issue. And this, I guess, loops back to the debate over what the kind of the base chain is there for ultimately in the long run. Is it there just for kind of large kind of settlements between the key economic kind of actors within the network, say exchanges and clearing solutions, etc.? And then the question is how much of that will be centralized, because at the moment, you know, the early vision of all of this was that everything would be decentralized and we won't need these kind of, you know, central intermediaries. And we're seeing that just be reinvented all over the place in crypto. We're seeing, you know, centralized custodians being widely adopted by the institutional players coming in because that's what they know and trust. But ultimately, you know, it kind of defeats the objective of the technology in the first place if we end up with kind of all Bitcoins or whatever crypto being held in these big central silos. So I guess the goal is to work towards something which is, if not fully decentralized, maybe mitigates counterparty risk better than we have today. And the idea of shared control or, partial control over these assets is ultimately the goal. So, we'll have to see how things pan out with sidechains, or whether, future developments on Lightning enable us to achieve some of these things. Before we move on to Statechains, which is something, a much newer proposition and quite interesting in its own right, can you just briefly touch on Taproot and Schnorr signatures, which will, if accepted by the network over time, over the coming year or so, and adopted by miners, what will this mean? What are these upgrades? What is Taproot briefly, and what will it mean for the network?
Yeah, so as we've said, blockchain is a finite space, and we need to, we need to keep the network on, say, Bitcoin decentralized, but at the same time, we want to basically, be optimal in how we use that space. So Schnorr signatures essentially allow us to compact by using a multiplication, compact a multi-sig signature into basically the same space of a single signature. So multi-sigs will end up being, not as expensive. So, we're going to save an amount of space there. Taproot is a kind of in a way, the best way to explain it, it allows complicated scripts to only reveal their kind of like their ultimate destination. So that's going to save space, and also that's going to allow more privacy type technology to be built on top. So I think what we're going to see once Taproot and Schnorr is allowed, we're going to see a lot more creativity in terms of smart contracts, ways to save space on Bitcoin that we have not seen before. And I think there'll be a few years of innovation that's going to get a lot of people excited in this privacy space, in terms of the kind of smart contracts we can build in Bitcoin, which we couldn't do before. Potentially we could do kind of things like covenants, so like conditional payments, etc., that that weren't exactly possible, and that's going to be pretty exciting, I think.
Okay,
especially as we start to see Bitcoin more used as a settlement layer. There's going to be settlement on pre-existing conditions and stuff like that.
So you'll be able to write conditions into transactions much more efficiently,
and not reveal them
as well.
Correct.
Yeah, interesting. So not sure if that directly relates to Statechains. If there is whether Statechains as a concept is dependent on that upgrade, or if you're able to kind of implement them now. But can you, for everyone that might not have heard of them or be aware of them, can you briefly explain what Statechains are, what the idea is around it?
Sure. So the original paper was written by a guy called Ruben Samsung, I think around 2018. But in his paper, he came out with the idea that there was a lot of dependency on future upgrades to Bitcoin, which are not there right now, like Schnorr and L2. But funny enough, we never went out to build Statechains. We were looking at something called discrete contracts, which are a way of kind of doing smart kind of contracts on the Bitcoin blockchain. But one of the issues with them is me and you could say get into like a smart a bet on the price of Bitcoin, and the problem is both our capital would be locked up in a private key. So we looked at things like Statechains as a way of novating that capital, novating your lockup. And so one of our CTO at CommerceBlock, he posted a message about how we could implement Statechains with today's technology on the Bitcoin mailing list. And before I knew it, CommerceBlock had committed to building Statechains. So that's how it kind of happened. But essentially, Statechains at a very high level is a way of transporting your private key to someone else. So obviously that sounds really simple. I have a private key which has a couple of Bitcoin in it. I can now give it to you, Paul, and great, you've got my private key. But the issue there is what happens if I remember the private key? I now can spend that money. So there's a lot of complicated maths to ensure that I can't spend that money after I've transferred it to you. So from a scaling point of view, it's awesome because now I can just move private keys around. But that does come with a lot of issues there, which we believe we've solved using today's version of Bitcoin. We use something called relative time locks. So there's a period of time where previous owners could not potentially take the Bitcoin. We have to do secure deletion. But one of the key things is it is non-custodial. It's not censorship resistant. So the state chain entity, if the state chain entity was to be taken down, I wouldn't be able to send you my Bitcoin anymore, but I would at any point in time be able to withdraw my Bitcoin. And that's why I think it's very exciting. Also, the transactions are all off chain. So if I have a staked coin, I can send it as much times as I want, and there's no footprint, there's no imprint onto the Bitcoin blockchain. So it's very scalable, and that's why we're quite excited by it.
Yeah. So as a simple analogy, if people are aware of kind of physical hardware wallets such as OpenDime, which is basically a secured, a sealed private key where if you can pass it around, but obviously it would be clearly obvious if someone had tampered with that seal. And if that seal had been tampered with, then the private key could be compromised. So, you know, it's not really of much use to you of taking it because the original owner could still have a copy. And so Statechains are essentially a digitized version or a digital version of that, where you can securely hand over a private key to a specific UTXO, which represents Bitcoin on the blockchain, and you can pass over ownership of that private key, securing the knowledge that, dependent on some level of intermediation, that can't be respent by the original owner.
Correct.
Very interesting. So as you said, this all happens off chain. So I assume there needs to be some level of intermediation. So there's someone that kind of adjudicates this handover process.
So there's a state chain. Yeah, there's a state chain entity which would help coordinate the transactions. So, you know, if I basically want to give you my private key, I have to communicate with the state chain entity. But, you know, I want to emphasize the key thing: if the state chain entity is not cooperative or misbehaves, I at any point in time can pull my Bitcoin out, because I always have what we call a backup transaction, which is a transaction that I can broadcast to the network to take my funds out. And then so it isn't censorship resistance, but it is, you know, in our view, non-custodial. And I think that's one of the key things. So you need to trust the state chain entity to move funds around, but you don't need to trust it in that it's kind of securing your funds, which I think is one of the novel things about it.
Yeah, so that entity itself is never in full control. They're just there to facilitate.
They're an orchestrator, they're not a custodian, which I think is very key.
Okay.
But, and the biggest limitation is that we are moving private keys around. So my private key has, you know, 4.1 Bitcoin. I can only send you 4.1 Bitcoin. I can't send you 0.1. So there's always a trade-off. But
yes, you have to send the full amount that is in that UTXO and hand it over. You can't send a partial transaction. Yeah. So that's a limitation, but a big benefit is it's fully off-chain. It's virtually instant. And there are fail-safes in place should that state chain entity go down. So I guess, I mean, we'll come on to what you're developing using that technology, but, you know, as a concept, you know, if we're looking at things like side chains for clearing, Lightning for clearing, this is a potential other use case where you could see funds moved around between different economic actors instantly and securely, with the trade-off that it would have to be the exact amount of Bitcoin in the UTXO being delivered. Okay.
I mean, I think many people have reached out to us from the Lightning community. We're very much not competition to Lightning. You know, as you can see, we actually complement Lightning quite well. Lightning is really great for micro instant payments, but it has a liquidity issue. With a state chain, there is no liquidity issue because you're just sending private keys, but obviously you couldn't use a state chain to send micro amounts or certain denominations. And I think other groups have actually written some articles about how state chains and Lightning could work together. And once, you know, we've kind of finished our kind of like reference implementation and we're live, we're certainly going to look at that. And another key thing about state chains is that we focus on the private key area. So obviously at the moment, we're very much focused on, on Bitcoin because that's where the market is. But we could, in theory, support any blockchain with a private key, which, as far as I'm aware, is at the moment every single blockchain. So we could support Ethereum, Libra, for example, CBDC coins, or whatever that's coming down the pipeline.
Sure, interesting. So I guess, you know, with things like Lightning channels needing rebalancing and that potentially being an issue, it could be complementary to Lightning at some point where this would be another cheap and easy way of rebalancing Lightning channels, I guess, or something.
Absolutely,
like that. Yeah, absolutely. So that all very interesting stuff. So how are you using it in the first use case? Have you got a product which you're developing, which
Yeah, so we're kind of more or less code complete on the back end, but, you know, CommerceBlock, we want to learn from our mistakes and make a very easy to use UI. So we're working at the UI at the moment, and it will essentially be a tool that will allow you to deposit your coins and then send them around privately. So we're hoping to be in test around January and hopefully in production sometime after. I mean, we're not going to release it until we're 100% sure, but we see it to be some sort of off-chain scaling solution, but with privacy as well. And I think there's a use case for that clearly, because a lot of it would be depending on what the market says. And also at the same time, we are speaking to institutions that want maybe more of a closed door solution on Statechains. So maybe not something that's so public.
Excellent. So when will that be released?
Well, everything we're doing is open source, so we're trying to have the code reviewed by the community. The back end, when I say we're code complete, we have a working operation, but it still needs to be hardened. And at that moment, we're working on the UI. So we've released some screenshots of what the UI would look, because it's a different mindset. It's, there's a mental thing here. You've got a coin which is not divisible. In a way, you're kind of going back to dollar bills and real money, because you're going to have fixed sets, and also that there is a timing issue. So there's a period of time where your stake coin can't be taken by a previous owner. So we've started to send gifts out of the way the UI look and get feedback from users. So that's where we are.
Very interesting stuff. I'm sure there's a lot more we can talk about this, and there's going to be a lot more to discuss in the coming years, I'm sure, as a lot of these new solutions start to be rolled out and adopted. But for today, Nick, thank you very much for joining us and sharing your thoughts, and we hope to have you back again soon to hear some more.
Thanks, Paul.
Cheers.
The much anticipated Ethereum 2.0 beacon chain was successfully launched this week. However, this is just the first of a multi-phase and multi-year process that will eventually see the network migrate from proof of work to proof of stake consensus algorithm. We spoke to Steve Berryman and Robert Olson from staking service provider Attestant to walk us through what happens next.
Hello and welcome. I'm very pleased to welcome two guests today, Steve Berryman and Robert Olson, co-founders at Attestant. Hi guys, thanks for joining us.
Hi Paul.
Cool.
Thanks for having us.
No, absolute pleasure. So Attestant is an institutional grade non-custodial staking service for ETH 2.0. Obviously a big week for Ethereum and the move and the kind of the triggering of the beacon chain this week as a first step in the process to migrating from proof of work to proof of stake for the network. And obviously this is something you guys have been closely working on and paying attention to. So could you just start out by obviously introducing yourselves, your backgrounds, and how the project came about?
Okay, thanks, Paul. My name's Steve Berryman. My background's mainly been in banking, in IT, but back in 2015, decided to take a look around and see what else was out there, and discovered Ethereum. When ETH2 came out, I just decided this was an area I wanted to look at. And there were a bunch of us who wanted to stake, and we all met up in Ethereum London, and we decided, well, why don't we just build something for ourselves? And then that eventually turned into Attestant.
Excellent. Bobby, a little bit about yourself and who else is on the team?
There's 9 on the team altogether. As you know, I've been in the space since like 2012. Yeah, just fascinated when I first got my first Bitcoin. It was that was thanks to Max Kaiser, and went down the rabbit hole and still digging. But yeah, so there's 9 of us now. There's we've got an amazing CTO, Jim McDonald. We've got an amazing CEO, Judith Das. We've got people in compliance, regulation. Got Ben Whitby, ex-HSBC. Obviously Steve. The team. We call it the dream team. Got to give another shout out to Gary Roei, who was the guy behind Multibit.
Absolutely.
So that was the first Bitcoin desktop wallet.
One of the first developers that I met in the space with way back. So excellent guy. So it sounds like a rock solid team to be moving forward with. So before we actually come back to take a closer look at Attestant itself and what it is you guys are doing, Obviously, a lot of people and a lot of viewers would have heard about the events of this week, seen some headlines, but might not actually be familiar with the processes and what actually happened and what it means. So could you just maybe give a brief overview of what happened this week in terms of the launch of the Beacon chain, what happened in the lead up to it, and what the immediate implications are going forward?
Sure. So this week, this is the week that really everything had to come together. So a couple of weeks ago, the deposit contract was deployed on Ethereum 1. And what this contract is the start of the Genesis block for Ethereum 2. And there've been a lot of trials on this over the last 9 months. And basically, all the teams have got to a point where they thought they were ready, and suddenly this deposit contract appeared and people like Vitalik started to deposit into it. It was deployed in a decentralized way, as a lot of these things are. It was the initial funding for it come through Tornado Cash. And this deposit contract is basically a dead-end contract, which is quite worrying. The money goes in there and it doesn't come back out again. So, but this is how Ethereum 2 is going to start. So what was going into here was being recorded on this new chain, which when it starts up would take this contract as the starting point for Ethereum 2. So that started, I think it was about mid-November, and by the 24th of November, it hit the limit of which it hit the amount that it had to reach in order for the Genesis contract to start, and that was about 500,000 Ether. Once that was hit, then there was 7 days before the Beacon chain would actually start. So then the various teams, there's various different client teams working on building the different clients for the Ethereum 2 were just finalizing their release. And on the 1st of December, so 2 days ago, 1 day ago, sorry, the thing just kicked off, and it was quite annoying because we had, people put a lot of money in, and everybody wanted to see a very clean and smooth start. In fact, we wanted it to be very, very boring. We wanted the thing just to, just to start and just nothing happen, and just start producing the first blocks. And that's what did happen. It was I think it was probably about 90% participation when it started, and that was good enough to get the finalization of the first epoch. And that was history was made for Ethereum 2.
So at this stage, as my understanding goes, we have the Beacon chain live. It doesn't actually do very much. And the idea is that over time, with additional phases over the next 2, maybe 3 years, additional components which will ultimately bring this whole thing together will be gradually added in and introduced. So at the moment we have a chain with the staking mechanism operating, and I guess similar to blocks on the existing Ethereum blockchain or the Bitcoin blockchain, we have an idea of something that's called slots, and that is all that's running at the moment. It's basically proving that concept and proving that works. Now,
correct, yeah.
The whole reason for this, in the first place, is to address scaling issues, which is obviously relevant to Ethereum, relevant to Bitcoin, relevant to most blockchain networks. So the next phase is going to be introducing sharding. So Robert, would you mind just kind of talking about that a little bit and explain what that is and how that kind of helps to solve the scaling issues that Ethereum's been suffering from up until now?
So there's going to be 64 shards when we implement the sharding, and that's just going to massively improve the scalability and the throughput of the network. So
in essence, these shards are basically different zones that operate independently, but then ultimately these shards or these zones are going to basically write to the main Beacon chain as it stands now.
Yeah, I mean, think of them as like side chains or mini chains.
Yeah. So
and then the Beacon chain is like the backbone.
And so there's a proposal, there's going to be 64 of these shards, which means in essence, you're getting, or the network is achieving a 64 times increase in throughput because each of these shards operates independently and then writes their transactions to the Beacon chain. The Beacon chain doesn't actually manage or bundle transactions itself.
Yeah, I mean, that is correct. I mean, I like to think of them as 64. I mean, there will be a lot more shards, but the first rollout or the next rollout of this will be the shards. And so the shards really are, I think of them as like 64 different chains. And clearly there's got to be some synchronization. But the idea is that most of them will run as independently as they can until they synchronize with the beacon chain. And that's where you'll get the extra throughput. And it is the shards where the transactions will be done. The beacon chain itself will just manage the shards, but it's the shards where we'll actually see the transactions. So even though that there's a bit of a roadmap and it is still changing, a lot of the software has been in development for a while. And what we expect to see is we expect to see the shards come in first, and then a small time after that, we'll start switching on the transactions so people can start, for the first time, start moving their Ethereum 2 around.
But again, as part of that process, initially the shards will have very limited, if any, smart contracting functionality. Yeah,
they'll be very limited. I mean, there may be small things coming in before, but some small things coming in as we go along. But there'll be a bigger, what they're calling phase 2, where there'll be the full virtual machine that goes in.
Right, and so we've basically got these 2 or 3 steps, little steps in between, which over the next time frame, whether it's 2 years, 3 years, will ultimately see us grow from just having this kind of relatively simple beacon chain running at the moment to the addition of an introduction of the shards, and then the final basically integration and migration of the existing network into the new network.
Yeah.
Now, if we edge back towards what you guys are doing, so we've, as you said, well over 500,000 ETH were finally deposited into the deposit contract. Those funds are effectively locked up, as you say, potentially a one-way street, albeit well, they will ultimately be converted into ETH 2.0. As long as everything goes to plan, then all.
It's important to point out that Ethereum is Ethereum. So it's a different chain right now, but it's still the same token.
Yeah, but those contributors have kind of accepted a big opportunity cost over the next year to 3 years, where those funds are locked up. There needs to be an incentive for that. So the initial incentive is that they are going to be rewarded in some way.
Yeah, so the way the reward system works is there's a certain amount of Ether given out all day, every day. So that doesn't change. It's a fixed amount, or pretty much a fixed amount. And what happens is the more people that stake, the more that same amount of Ether has to be divided by more people. So, if the Genesis block just started with the 500,000, it would have been around 22%. But we've already seen that the Genesis block was more than that, and we've now got 1 million Ether in the deposit contract. So you can see that, for example, that you're getting 22% if you had 500,000 Ether validating, or 16,000 validators. But if we get to 32,000 validators, you can get roughly 900 in a day, so 17, 18 days, we could have half the rewards.
So, okay, so we've got all this place. Thank you. I think you've painted a clear picture of the process and where we're migrating towards. Now, you, as we said at the beginning, Attestant has established itself, or is establishing itself, to provide institutional grade, non-custodial staking services specifically for ETH 2.0. So before we come into that, as we know, the idea of staking, and originally proof of work mining, but that became ever more difficult, was that anyone can participate. It's very difficult with Bitcoin mining now, if you're not operating at an industrial scale. Now, before someone might decide to come and use you, if I'm an individual and deciding I want to stake myself on ETH 2.0 at home, what would my cost be? What would I need to do? And what would the risks be for me?
Right. I mean, it doesn't need, unlike mining, it doesn't need huge compute power, but what it does require an element of understanding the security risks of setting something up. So I think there is one group that have got it running on a Raspberry Pi, although I wouldn't personally recommend that. but there are people trying to run the software on that. One of the reasons is you do need to also run the Ethereum one chain, unless you're going to, because you need to be able to read the deposits to be able to process the beacon chain. So unless you're going to use, you could use Infura or something like that, but if you want to run everything, that in itself is 400 gig to run that. So a modern computer would be fine to run the beacon chain. I would suggest 64 gig. It probably work quite happily in 32, but give it plenty of memory. So you could probably for £1,000 get the type of box that you could run a basic setup. I mean, the only thing is the launch pad is the Ethereum Foundation created this launch pad, which is step by step, easy steps to go through. But it started to get scary the more steps they've added in for the non-techie person, especially around firewall settings and security. Because with mining, you don't really have much to lose, apart from if you get switched off, you just don't earn any rewards. Mm-hmm. But with this, you're keeping hotkeys online, so you've got to be aware of some of the security problems. You certainly wouldn't want to just use it on your standard machine, because you want to keep the amount of software that's running on that machine to a minimum for malware and all these various other things. But you probably also want to have some basic understanding of how to harden up the firewalls and to keep things like that. So there are good guides to do it, but it's a different problem with proof of work. It's lots of compute power and graphics cards here. There is a requirement to have some basic understanding of setting up the security. And I think if somebody's keen, it's not difficult, but it's a bit time consuming in trying to make sure that you get your configuration set up. And if you've got no network experience, you may find it quite tricky.
As we all know, there's more institutions moving in. They're going to be looking at these opportunities to generate yield on their assets that they're holding. This is where Attestant comes in. So if you can just explain, in terms of your architecture and your security, what is it that you're bringing into play that's going to give this comfort to your the type of client base that you're going after, and where it makes most sense to use services such as yours?
Yeah, sure. I mean, we would always encourage people to do it themselves, because we think that's what makes this Ethereum more interesting and decentralized. So, it's not that Attestant is just going to be, it will be a few staking services. I think a lot of people will try and run this themselves. The one thing that is unique with Ethereum, certainly I haven't seen before in any others, is there are two keys. And I think a lot of them will start going this way. There's a withdrawal key, and there's the key that you do your validating. And the advantage of this is that at least the withdrawal key doesn't have to stay on your machine. So even though you've got slashing risk, you don't have the same key. A lot of the proof of stake systems have got the same key. So if somebody gets on your machine and manages to get your key, you lose your funds. Here, the worst that can happen is they can slash your funds, which is not great, but at least there's one level of protection there. But the one thing that Attestant is doing, Ethereum 2 comes with a new cryptographic curve called BLS curves, and they've got some amazing characteristics. And one of the characteristics which work very well with proof of stake systems is that they can aggregate signatures together. So you can take 32 signatures and add them all together, and then it's not much bigger than the original signature, and you can still prove the 32 signed it. So this great characteristic reduces the size of the chain for these proof of stake systems. And Ethereum's probably, I think it's the first one using these new BLS curves. But the thing we're doing is we're taking that to use it for our key signing. So whereas normally there'll be one key to sign for a block, what we've got is we've split the keys up, and they're actually created in a distributed manner. So we call the system Dirk, and it's something that we've got blogs, and we've made the source code open source. So what we do is we create a key from, you pick a number, but you say you've got five keys. You create these keys on 5 different machines, and then we say there's a threshold that 3 of them have to sign. And it's not just that they're signing for that block is they're all signed independently, then they're combined together, and then that's what goes out into the beacon chain. So it becomes very, very secure, because unless you can get access to all the signers, you've got no information, because the aggregation of the signatures gives you nothing. Even if you've got the signatures before they're aggregated, doesn't give you anything, because these are just signatures. And it's just amazing that these signatures can then cryptographically be added together to create the value on the beacon chain. And so this approach gives a different level of security, because the signers can be distributed around the world. They can be absolutely locked down, and even if somebody had managed to get hold of one signer, it doesn't give them any information. So we've built this system called Dirk, and we've built a validator called Vouch, and these two components work together to not only secure the set of keys, because they have to go through our protocol, but the Dirk also secures slashing. So there's a slashing database on each of the signers, and they know what they've signed. So if we get past something twice, it just won't sign it. So, you know, we've spent a lot of work and a lot of effort on this technology, and we have put it out into open source, because we want the community to look at it, help audit it, make sure, you know, we've been testing with it for, I think, 9-10 months now, but you know, it's our contribution to the community as well. But we think that a lot of people will take this distributed key approach as they start to understand what these BLS curves are capable of.
Sure. So I guess
as Steve was just explaining there, you know, the infrastructure that we have in place and the code that we've written over the last year, because it was July last year we started talking about this. This is where the people that are coming to us, they're banks, institutions, financial institutions, high net worth individuals, family offices, you know, they have tens of millions of ether they need staking on behalf of their customers. And the golden rule is don't lose the collateral, you know. So we optimize for not losing your funds as opposed to maximizing your return. So, you know, like we were saying before about the running it from home. So someone doing it from home in their cupboard on a Raspberry Pi versus 9 people dedicated to, you know, forming this company that's is chalk and cheese.
Sure. Well, and it's always back to the case of getting the balance between security and efficiency. And we've seen that no different, I guess, from the custody space, where it was all very kind of vertical security model, which just had, you know, and full cold storage models, which just had, you know, extreme limitations, I guess. And as we've started to see the rollout of multi-party computation, and you've got more of a horizontal security model, then that's the same sort of thing that's being applied here.
Yeah.
Excellent, very interesting. So we're talking about institutions. I guess the other subject that normally comes up with institutions and goes hand in hand is around regulation, but also with these new models where, as you said, you're non-custodial. So in an old regulatory regime, you might have been considered a custodian if you're providing similar services, but obviously that clearly doesn't apply. Where are we at with this? Is this even hit the regulator's radar yet?
What I can tell you is we've been in discussion with the FCA, and we're outside the regulatory perimeter.
Right.
So we are effectively software as a service.
Okay, so that's all it is, because you don't have any direct control over users.
We don't custody the keys, so they don't send the funds to Attestant. They send it directly to the deposit contract. So at no stage do we receive funds, handle funds, exchange funds.
Yeah.
You know, with regard to our fees, we can't even take our fees from the customer's funds or the customer's rewards, because we can't access them. So yeah.
Okay. Exactly.
But this is a space we are going to be watching, though, because we do think regulations are coming, and we think they probably will cover staking services at some point.
So I guess this doesn't necessarily apply to the type of clients that you have, but as I understand, the minimum staking deposit is 32 ETH at present. Potentially, as the price of ETH increases, that's going to become quite out of reach for some people to participate. Is there or are there plans for mechanisms for users to pool resources to be able to?
There's a great one. There's one called Rocket Pool, and that does pool people's resources. So you know, you can have singles, multiples. You might not have the full 32, but there are ways to stake. Yeah, so that's with regard to it, that 32 may be changing. Wouldn't have thought so, but you can't say. But
yeah, the one thing I do see though, and this is something we Attestant wants to get involved in, is once we can build smart contracts on Ethereum too, it opens up a lot more possibilities. So the 32 ETH might stay there, but you can imagine you can tokenize it in some way where you could build a smart contract which has access to which is a staking pool which Attestant run, and then people can swap in and out into that, you know, like a fixed exchange rate based off what, you know, they get a percentage. So they own 1% of the pool. If the pool increases because of the rewards, then when they pull it out, they get the rewards. So I can see there've been a lot of services but that's clearly not going to work until the functionality for smart contracts is available in 2. So I don't think it will change the size of the 32, but there will be a lot of innovation in that space once smart contracts are deployed, the infrastructure is deployed on Ethereum too.
Sure, and I guess with these ideas of yield and interest, then we start getting into sort of traditional money market stuff and having yield curves and
yeah, I mean
that is really exciting. That's sort of Attestant 2.0, and that's where Shrewd Das really will make your hair curl with some of the ideas we have.
Yeah, I think
this is going to be the new credit risk-free institutional rate.
Yeah,
we see this as being the staking being the risk-free credit rate of the Ethereum ecosystem. So, you know, once we get going, it'll be like the treasury bonds. You know, it's the non-exciting stuff, the stuff you get a return, but you don't really want to do. You know, because I find people questions saying, well, you know, what's the difference between doing DeFi and staking? But to me, it's the same question: do you want equities or treasuries? I mean, you know. There's a reason. It's your age or where you are in life. You know, there's not a right or wrong answer, and it's the same with this. I think staking will be, in the future, probably the lowest return, the safest investment, and everything else builds on top of it. And there will be like an Ethereum yield curve, as you said.
Yeah, absolutely. I mean, we're going to see that. It's going to be interesting. I mean, I was looking the other day, and some of the forecast kind of staking rates, which, given a certain amount, maybe will be around 5%, and that's kind of pretty similar to the current kind of DeFi lending rate for ETH. So there's going to be competition there. There's going to be liquidity issues potentially with people getting overconfident on staking, having lots of ETH kind of locked up on DeFi platforms, and then that's going to open up questions about actual liquidity of ETH as a asset in the markets. But, you know, these are things that we'll discover at a future.
Yeah, exactly.
We can definitely get you guys back on and others to talk about this as these things roll out.
Just before we wrap on that note, I just want to give a shout out to Crypto Compare, Vlad and Charlie, because they'll be helping us publish the Attestant overnight rate. And that's going to be, again, a game changer in the ecosystem.
Excellent. We look forward to that, and a great team to choose to work with. Guys, it's been an absolute pleasure. We could definitely talk more, but it's best that we save some for next time, and especially as these different phases roll out, it's going to be really interesting to see what happens and to get you back and hear your thoughts. And wishing you both the best of luck and every success for the future rollout of Attestant 2. Thanks for joining us.
Thank you very much. Appreciate that.
Thanks, Paul. Yeah, appreciate it. Thanks.
Thank you.
You've been watching Coinscrum Markets. Thanks for joining us, and see you again next week. Please don't forget to subscribe to our channel in order to support us. Thank you very much.